Hello, people. My name is Mensa Isaac. We are going to talk about partnership accounts. As we know already, for sole proprietorship, it is a business formed by one person with the aim of making a profit. Good. But in partnership accounts, we are going to involve two or more people coming together to make a profit. So in sole proprietorship, you will see that any account we draw or make up involves only one person. Okay, but in partnership accounts, since we have two or more people coming together to form a business and make a profit, we are going to see two or more names or two or more accounts. Okay, first of all, as we said, partnership is the formation of a business by two or more people with the aim of making a profit. Good. And the practical aspects in partnership accounting, you may be asked to adjust net profit. Okay, adjust the net profit. Good. And to adjust a net profit, the initial net profit will be given to you. Okay, so you first have to come and think of it. Okay, the items given to me in the question, which of these items will affect the net profit? Do you get it? So we know that for net profit, the items that will affect net profit are found in the trading profit and loss account or the income statement, right? So let's say we had general expense to be 1,000, okay, and our net profit was, let's say our net profit was, let's say 50,000, and let's say we had goods drawings, okay, goods drawings to be 5,000. Okay, so at the end of the year or the accounting period, we had a net profit of 50,000, and we got to realize that okay, these things were not recorded and we have to adjust the net profit. Good. So how are we going to do it? We know that net profit was 50,000. Good. So what we are going to do is we will add those items that will increase our net profit to this net profit. Okay, and we'll less those items which are supposed to decrease our net profit. Do you get it? So first of all, we know that when there's goods drawings, okay, it's going to what increase our net profit. So what we'll do is we'll add any goods drawings. Good. So when we have goods drawings of 5, we had good drawings of, yes, 5,000. So we are going to add the 5,000 to this 50,000, and we are going to get 555,000. Sorry, this is an example. Okay, so we also have general expense of 1,000. Okay, we know that expenses will definitely decrease our net profit. So what are we going to do? We will less expense from the things that are going to increase the net profit. So when we less the expense, which is 1,000 Ghana cedis, we are going to get 54,000 Ghana cedis. Let's come back to this explanation very well. You see, we have a net profit of 50,000, okay, and expenses. In our income statement, we know that net profit, let's take the same net profit, okay, which is 50,000. If I make more expenses, okay, I have 50,000, I'm making more expenses, okay, money is getting out of my pockets, money is getting out of the business. So that means if it's an expense, I have to subtract that expense from the net profit. Do you get it? So that's why these expenses were subtracted from the net profit. Do you get it? After adding these goods drawings, getting the things that will increase the net profit. We subtracted these expense, anything that is going to decrease our net profit from the net profit. Do you get it? So we subtracted this 1,000. Goods drawings. Let's come to this explanation. We have goods drawings to be 5,000 and the net profit there was 50,000. Good. You know, in the income statement, we will less goods drawings from our purchases, right? And we have goods drawings here to be 5,000. We know that when we purchase something, okay, we have the money. It's going. We've purchased something. Good. The money was with us, right? And now we've spent the money. So it's supposed to decrease our net profit. Do you get it? So if mathematically we are purchasing 5,000, okay, and we've removed 50,000, okay, from those purchases. If the purchases will decrease our net profit, that means if we are subtracting from the purchases, it should increase our net profit. Do you get it? So what we are going to do is we are going to add the drawings to the net profit. Good. So this is how to go about adjustment of net profit. Now let's look at how to prepare our profit and loss appropriation account. Okay, so this is how to adjust the net profit. And when moving on to the profit and loss appropriation account, the typical format for profit and loss appropriation account is we have to bring the adjusted net profit. Okay. Here, let's say we have a Ghana cedi, the currency sign is Ghana cedis. Good. And let's say we had a net profit of 54,000, right? Good. If you go to the question, let's start with this. So if you check the typical format for profit and loss appropriation account, after getting your adjusted net profit, you add interest on drawings. Okay. Why are we adding interest on drawings? Good. You know that if the partners make drawings from the business, okay, it has to attract interest. So if you are making a drawings and I'm going to receive interest on the drawings you've made, remember that the business is separate from the partners. Okay, business entity concept. Good. So if we are making a drawing of, let's say, 5,000 and it's going to attract an interest of 500, the business is going to get, the drawing is 5,000 and it's attracting an interest of 500. That means the business is going to receive 5,500. So if I'm receiving an interest of 500, sorry, if I'm receiving an interest of 500 from the 5,000 that you've made or drawn, that means me, the business, which is having this net profit already, is going to receive another interest. Okay, so that interest the business will receive as a result of you making a drawings from the business is going to add up to the net profit. Do you get it? Good. So with that, if there is any interest on current account with a debit balance, interest on capital account, okay, if there's any interest on capital account with a debit balance, okay, we are going to add that one also to the net profit. Good. Now this we are still on the format. So we'll go to less our interest on capital. Interest on capital. Good. So if there is any capital the partners introduce into the business, it's going to attract some interest. So if the interest is, let's say, 500, I've given to you the business entity, separate concept. So I've given to the business, okay, this is what I'm investing into the business. Good. I'm going to attract some interest. So that means that if you, the business, you have 5,000 and I've added, let's say, 100, I'm going to receive an interest on the 100. So that interest I'll receive as the business who is going to give me, the partner, the interest. So that means that it is reducing the net profit of the business. Do you get it? So that money doesn't belong to the business. It's my interest, the interest you have to pay me as a result of the capital I introduced into the business. Do you get it? Good. So if we introduced any capital, the interest on the capital is going to be less from the net profit. Okay. So let's say we have an interest. We'll write it here. Good. We'll also check if there is any partner to receive a salary. Okay. So if a partner A or partner B, either of them, let's say partner A, is to receive a salary of, let's say, okay, so a salary, and let's say the partner is partner A. Okay. So partner A is going to receive a salary, and who is paying the salary? The business is going to give me a salary. Do you get it? As the partner, the business will give me a salary from this net profit, the profit that the business has made. I'm going to receive my salary. Do you get it? So let's say if partner A had a salary, we bring it there. Okay. So we'll add these and we'll subtract from this one. Okay. So after adding those items that you, the business, the partner, is going to pay to the business, after adding those items, you, the partner, is going to pay to the business. Okay. You also add, here is current account. So if you also have any item that you, the partner, you are going to receive as a result of your amount contributed into the business, those items will be recorded here, and those items will be added together. You bring them here, you less it from these items, that's the items listed here. Then you get your residual profit. Okay, so from this residual profit is what the business or the partners are going to share the net, going to share their profit. Do you get it? Okay, good. So from this residual profit is what we are going to share to the partners. Okay, so if let's say we have partner A, and the question says the partner is going to receive, let's say they are to share profit 3:2, right? Let's say we have two partners and they are to share profit 3:2. Good. So respectively, and the question puts it this way: partner A and partner B are to share profit 3:2. Good. So partner A is going to be 3/5, and partner B is going to be 2/5. Good. I hope you all know respectively. That means the first partner is going to receive the first fraction and the second partner is going to receive the second fraction. Good. So partner A is receiving 3 over 2. Good. So 3 over 2 times our residual profit. Okay. And partner B is going to receive 2 over 5 times our residual profit, right? Good. So what we get will be what? Added together. And what we get here should be equal to our residual profit. Do you get it? Yes, because the partners, if they are 3, they are sharing the residual profit. Good. If they are 2, they are sharing the residual profit. If they are 4, they are sharing. So what you will get for the sharing of the residual profit by the partners should be equal to that same residual profit. Good. So what are we going to do? After profit and loss appropriation account, we have to prepare a balance sheet. Good. So this is how we are going to go by our balance sheet. We know that for sole proprietorship, the only thing that is going to change here is our finance by. Yes. So let's move to the finance by side because we already know how to deal with the sole proprietorship approach. Good. So if the question asks you or tells you that the capital account is to remain fixed, that means that only the capital amount will be recorded in the capital account. Okay, so let's say we have our capital accounts. Here is our debit side, credit side, and let's say partner A, partner B, partner A, partner B, and partner A. Okay, partner A introduced a capital of, so this was the capital. Good. This is the capital. Capital accounts have a credit balance. Good. So this is the capital of partner A and partner B. This is what the question is trying to say about capital accounts remain fixed. That means that only capital amounts are to be recorded here. So after this, we should be done. Okay, and you are still going to get the same amount because it's only the capital amount that is being recorded. Good. The question can also tell you that, okay, partner A introduced introduced a capital, additional capital of, let's say, this or 5,000. That amount will be added to the capital brought down, and we are going to get a new amount, balance carried down to be this amount. Okay, so if you check this, it's only the capital amounts that are being recorded. Do you get it? Yes. So we'll close our account, and this balance CD here is what is coming to the finance by in the statement of financial position. Good. So what are we going to do? We are going to record our capital account, current account here. So when it is a fixed account, that is, if the capital is remain fixed, that means we also have to open our current account separately. Good. So the current account will be here, and the format for current account is quite simple. We know that current accounts have a credit balance. Good. So all the balances, let's say partner A, partner B, here is partner B, partner A. Okay. So debit side, credit side. So any amount of the current account will be brought down here. So the balance BD will be here, and A will take his, B will take his. Okay, like this. And also, it can be a case where there might be a debit balance on the current account of one partner. So if, let's say, partner A was having a current account overdrawn or a debit balance on the current account, his balance will come here instead of coming to the credit side. Okay, if only he's having a debit balance on the current account. So let's move by the normal way. Good. All right. So current account, you are going to use, first of all, you just compare the items in the profit and loss appropriation account. We know that we have the items that the partner will receive, the amount the partner will receive was the interest on capitals. Those things will be recorded at the credit side. That's the amount the partners are going to receive will be recorded at the credit side. And the amount that the business is going to receive will be recorded at the debit side. Do you get it? So you check that. So also, if the amount is going to increase the partner's pocket, okay, if the amount is going to increase the partner's balance, record it here. If money is coming into the partner's pocket, record it here. If money is going out of the partner's pocket, here it should be recorded. Good. So this is the basic way of letting you to understand. And we know that some of the items that will come here is interest on capital. Let's say salary. Let's say share of profit. Yeah, so these are some of the items that will come here. And the items that will come here are interest on drawings, you see, and drawings will also come here. Good. But when you check the profit and loss appropriation account, there is no drawings. So you see the difference. Drawings is going to be here in the current account. So take note, every day, every time, interest on drawings and drawings is at the debit side of the current account. Good. So we are going to record the amount here. The amount here. Amount here. So if the partner salary was to partner A, it's going to be here. If the salary was for partner B, it's going to be here. So let's say the salary was for partner A. Good. And interest on capital, any interest on the capital will be recorded here. Okay. The share of profit by the partners on the residual profit, what each had, will be recorded here. So these are some of the items that will be recorded in the current account. Good. So we just find which side is greater, okay, and we record it at both sides. And normally in current accounts, the credit side is greater or bigger than the debit side. So what we are going to do is we are going to close our account. Let's say the credit side is bigger than the debit side as usual. So we'll close the account. Close the account like this. Then we know that obviously if the credit side is bigger than the debit side, we will get our balance CD at the debit side. Good. So this balance CD will come here as balance BD, balance brought down. So good. There can be a case also where we will get the credit side of A to be bigger than the debit side of A. Good. That means we will get our balance CD here for partner A and our balance BD here for partner A. But if we check and partner B's amount at the credit side is less than the amount of partner B at the debit side, which means partner B's amount here at the debit side is greater than partner B's amount here at the credit side. That means we are going to get a balance CD here for partner B. It's not always going to be the case that because partner A's here is greater than partner A's amount at the debit side, so partner B's amount should be also greater than the partner B's amount at the debit side. Good. So what we are going to do is we just check each as a separate account. Good. So B's amount is greater than B's amount here, the same partner, but he had a credit side amount to be bigger than the debit side. So that means you are going to have his balance CD here. So in the case where B's amount at the total at the credit side is less than the amount at the debit side, we are going to have B's balance CD here. Do you get it? Good. So we have to check that. So this balance BD, that we've gotten here will come to the finance by. Good. So we've known how to go about the current account and the capital account, which is the main difference in the.
Yes, so this is the only difference between the partnership account and the sole proprietorship. Is in the sole proprietorship, when we are recording our finance by, we have capital because it's only one person. Maybe you just write this. Because it's only one person introducing capital, there's only one amount there. And we add net profit. We take away any drawings. And when we get this, we add any long-term loan. So loan. Then we get our bonus equity. Good. But in partnership accounting, you see there are two or more partners contributing capital into the business. So what we have to do, we can get capital to be, let's say partner A introduces his capital, partner B will bring in his capital. You see, it's a formation of two or more people. Good. So you see, instead of having one capital contribution, we have two. It can be three, it can be four. Do you get it? So let's say we have two partners forming the business. So after getting this, we have our capital account, our capital amount here. Then the balance we got for the current account. Okay, partner A, partner B. So we bring partner A's amount here, partner B's amount here. Then we write the amount here. Good. Do you get it? So this is the capital account. For sole proprietorship, we wouldn't have seen anything like current account. But you see, when we get to the finance by for partnership account, when we are recording the statement of financial position, when we get to the finance by, the capital account involves capital contribution of more than one person. Do you get it? But the sole proprietorship will involve just one person because it's a one-man business. But for the partnership account, we will get partner A, we will get partner B. Yes. So in sole proprietorship too, you can see that we have nothing like current account, but in partnership accounting, we have current accounts in the finance by part. Good. So after writing our capital for both partners and the capital balances for current balances for the partners, we add them and bring them here. Good. We add them again, these two amounts, we will bring them here. So if there is any long-term loan, long-term liability, we will bring that one to there to add to that amount. So we are getting this amount. So at the end of preparing this finance by, you should get an amount that will be the same as the net asset. You get it? And the net asset we know is working capital plus non-current assets. Okay? So the working capital plus the non-current assets should be equal to the owner's equity. Good. So this is all for the statement of financial position for partnership account. Yes, so we'll end here. I'll meet you in the next episode and we'll be solving one or two practical sets, and that's it. Once again, the name is Mensa Isaac. See you the next time.